Hi everyone, it's Mark. Welcome back to my channel. Today I'm going to talk about real estate. Specifically, I'm going to talk about real estate tax deductions. Now, most people when they talk about real estate investing, they focus either on appreciation or cash flow. And while both of those are fantastic benefits from rental real estate, I think tax deductions are equally as valuable, and for me in the beginning probably even more valuable, and they're discussed much less frequently than appreciation or cash flow. So that's what I'm going to cover today. I am super pumped to provide all this information to you. And first, if you haven't subscribed, if you could go ahead and do that for me, I would really appreciate it. And as always, if you could help me out with that YouTube algorithm and smash the like button. All of the deductions that you can take on your federal return can be found on your Schedule E. There's quite a list of them. I'm not going to cover all of them today. What I am going to cover are my 4 favorites. All of the deductions that I'm going to cover today will help to offset or reduce the rental income that you receive in rents from your tenants. And I'm not an accountant, so don't take this as accounting advice. You always want to discuss this with your accountant. However, if those deductions exceed what you collect in rent and you actually have a loss on the property, it's possible that you may be able to use that loss to offset income from elsewhere, from your job, for example. In the past, I was able to take those losses from a rental property and use it to offset my salary income, and then use those tax advantages to buy additional rental real estate. The first one, I'm actually going to combine 2 categories. It's cleaning and maintenance combined with repairs. And the reason I'm going to combine them is because there's a little bit of a gray area between what is a maintenance item and what is a repair item. Cleaning is pretty straightforward. If a tenant moves out and the property is not in the same condition in terms of cleanliness that it was when they moved in, maybe you have to mop the floors, you have to clean the toilet, you have to clean out the oven, wipe down the kitchen cabinets. Those are all tax deductible if you pay anyone to do that cleaning work. Now, repairs are something that you would do when an item in the property is not working at all. For example, if there's a leaky faucet or the faucet doesn't work at all so the tenant can't get water, if the toilet is plugged up so the tenant can't use the toilet, or the air conditioning just doesn't work at all. Those would be repairs. Maintenance is something that extends the life of an item in your house so that it doesn't become a repair. For example, if you change the filters in your air conditioning unit, that reduces stress on the air conditioning unit, allowing it to last longer. That would be considered a maintenance item. If you patch the roof of your rental property, that is also considered a repair. However, if you replace the entire roof, that would not be deductible as a repair. I will cover that topic later in this video. Auto and travel related to the property is also tax deductible. So if you make a trip to the property to inspect the property or do repairs there or hold an open house to get it rented, or even just to look at a property that you're considering buying, that trip is tax deductible. You can take mileage for your car. There's a standard deduction if you drive, and if you fly, you can deduct the cost of the airplane ticket, any parking fees when you park at the airport, as well as a rental car when you arrive at your destination. When you travel for business, including when you go to inspect your rental property, your meals are typically partially deductible as well, normally at the 50% level. One other point about auto travel is that if you take a trip and part of it is for business to inspect a property, for example, and part of it is pleasure, that is partially deductible. The time and days that you spend on business inspecting the property or having an open house, those are deductible. The third deduction is mortgage interest. With the current state of very low interest rates, this isn't as valuable as it used to be. However, it does still hold the same principle that every part of your monthly payment to your lender in a rental property has value for you. The principal part of your payment reduces your loan balance, which makes you wealthier. Your taxes and insurance and the mortgage interest are all tax deductible, so those lower the amount of taxable income that you have to declare. Even with the low interest rate in today's environment, the mortgage interest rate deduction can be worth thousands of dollars each year. The value of deductions are based on your federal tax rate. For example, in the 22% tax bracket, if your payment was $1,000, in the very early part of your mortgage, almost all of that will be interest. So I'm just going to assume that it all is, even though that's not really true. To make this example simple, then if your payment is $1,000, then $220 of that is a tax deduction. So that makes your effective payment $780. The main benefit of rental real estate continues to be the fact that your tenant makes your mortgage payment for you every month effectively by paying you rent that you then use to pay your lender. And at the end of the loan term, 15 years or 30 years, you own the property free and clear, and then you no longer have a mortgage payment to make, and your cash flow is greatly increased. With the current state of very low interest rates, 2 to 3% in most cases, it does not make sense at all to prepay your loan, in that you can always make an extra payment and reduce your loan balance. But right now, if you're doing that, your rate of return is only what your interest rate is, 2 or 3%. I do not recommend doing that with the current low interest rate environment. The final tax deduction that I'm going to talk about is depreciation, and it's probably my favorite deduction of all. I call it the gift that keeps giving. I've talked a little bit about repairs, and those are items that have to be fixed right away. But if there's an item in the rental unit that has a useful life, for example, an appliance or a roof or even the property itself, that has to be depreciated over the life of the useful asset. So for example, appliances, it's 5 years, carpet, it's 5 years, and the property is usually 27 and a half years. That means you only take a little bit of the depreciation on your taxes each year, but you continue to take it every year until it's entirely used up. And the reason I love this is that it spreads out the tax benefits over many years. And the best part is that for the property, it's not a cash out of your pocket, but you do get the tax benefits. You don't pay the entire price for the property in cash, typically. You will get a loan, you only put down a small down payment, but you can deduct the entire price of the property. That will often turn a positive cash flow property into a negative tax property. So you can take a tax loss on that against your other income. One thing to note is that only physical assets that have a life are depreciable. Land is not depreciable, so when you first buy the property, you need to separate out the land and the building itself. Typically, 80% is acceptable for the IRS, 80% to the building, and 20% about the land. The great part about depreciation is that the IRS looks at it as an asset that has less and less value every year, but in reality, the property is probably increasing in market value if you were to sell it. That's what I think about real estate deductions. Those are my favorite ones, and that's how you can use them to make money and save money on your taxes. If you've made it this far, I would appreciate it if you were engaged with me. Go ahead and leave a question, leave a comment down below. I do read all of my comments. Until next time, this is Mark. I'll see you later. Thank you.